Hi Warriors, hello viewers from investing.com. I'm Dale Pinkert. Welcome to FACE. That's ForexAnalytix Community Experience. I believe most of the team is going to be here, and what a team we have. Starting off with Blake, well known for his show, The Morning Edge, for decades. Nicola Duke, widely followed everywhere on Twitter and Facebook. Grega, award-winning Elliotician, interviewed him when I was on FX Street in LAR. Interviewed Blake too, said, boy, one day it'd be fun to work with these guys. There's Stelios Kantos, met Stelios when I joined FACE almost a year now, guys. We've been broadcasting these webinars. It's definitely our mission and our hope that we're building everyone up and edifying you every day. So every day, just like Olympic athletes on the slope, leave it on the mountain. We leave it here in GoToWebinar for you guys, trying to teach and provide actionable ideas. Here's Stelios Vulgardis, known as Steve, aka Steve, one of the most disciplined traders I've ever met. Stelios has great macro views. We always turn to him to give us the big picture. There's me hosting FACE, and Amanda Sweeney is in our private chat for subscribers, does a great job. She trades for a living and keeps the room going. We have a real nice private chat room here. Just show you a quick view of what happens here. So FACE is an hour and a half, an hour of analysis, and a half an hour interview. And that reminds me, what a great interview I have today. A huge response on Twitter for my guest today, Michael Huddleston at IMICT. So he's a mentor of mentors. I've interviewed people he's taught that now teach people. So he's really blazed a trail for many traders that are now professional because of his teachings. Looking forward to doing that. So we had a great wild, and you guys know I like wild, Fed FOMC minutes yesterday. Here were the S&Ps. So I really think this was it. Earlier in the week, I thought we could get back up towards this 2770 level, but when I saw the bulge here in the fade, I put on some bearish positions. In related derivatives on the S&Ps, we're trying to fight our way back. The only thing I think that could be a real good catalyst to bring it back and squeeze shorts one more time would be the dollar turning. And it's really been quite a nice grind up, quiet, sneaky, not all at once, dramatic, but look at how much the dollar has appreciated. It hasn't even been 5 trading days here. My intuition says don't chase the long side of the dollar. Yesterday there was a decent scalp from 23 when I called it out at the beginning of the session. You had between 30 and 60 pips until right after the FOMC minutes. We're still diverging down here. I'm still more inclined to look for the euro to do something right. So the only thing that it's doing right is it's not as weak as cable. Expressed through euro pound, up a little bit, again contained, contained. What's going to happen here? I would say if we start penetrating this level here, there's something positive going on, but right now it's a coin toss. So someone put a gun to my head, I would say that we're probably heavy here. I was looking for a big move. I thought we'd get a move to the upside over this period of time, and I finally have capitulated. Think that we'll test the downside of the range. We'll get a look at that from Steve in a little bit. And that's really kind of a wrap. It's really the dollar's the linchpin, but I think the tail wagging the dog now are equities. And there's either one more shot up, but let me talk my book. I'm thinking it's over here from yesterday, and that this is just a little oversold bounce, and we start penetrating 2680. I think 2600's around the corner. My big picture is to pat for this double bottom that the 200-day moving average held. I believe that eventually, whether it's from here or another shot up before we make new highs, that these lows will give way. Ellioticians that look at equality, this was 350, so 350 from here. They have targets down here around 2420, 2410, and on a weekly basis, we have an inside week. Everyone knows I'm more negative Russell, but you know, Russell actually led the way up, it led the way down, and yesterday had a pretty negative day. Part of the reason the Russell will outperform is during periods of dollar strength. So Russell had a real nice recovery here, but it went right back to the wedge line up here. Not a great looking close. I kind of have it in a broadening formation now. I'll throw in the towel on closes over 56, but I really do think there's a chance, at least for these lows, to be taken out at 138 and maybe even test the August lows. One of the reasons I believe it's an August low is I'm defining this as a rising wedge. The rule on wedges is that they can retrace 100% of the move. So I have confluence between this low and a megaphone line on the downside. So that's my look. Let's have a great session. With that being said, I'm going to bring Blake on. I introduce the team. The advantage, one of the biggest advantages besides the very good trading minds that the team has is that all the different methodologies you get at ForexAnalytix. So, you know, normally you subscribe to the service, they're Ellioticians, or they do harmonics, or they do candlesticks. And you could find all of these methodologies in one place here at ForexAnalytix. And then you could look for confluence when people that do Elliott and people that do harmonics and people that do traditional or conventional technical analysis, especially this crew, are all pointing towards a similar outcome. To me, that's a very high conviction possibility outcome and trade actionable, especially if they're on the same side of the analysis and a pattern in play. So yesterday when I talked to Blake and I was talking about, you know, the risk reward and being long euro, it just worked for a scalp. You know, anything I call out, if you have anywhere between 15 and 30 pips, you take half and you tighten up your stop. But man, buddy, we're do or die here pretty soon, don't you think?
We are.
Blake, are you with me?
Yep, I can hear you. Can you hear me?
I can, buddy.
Excuse me.
So euro do or die here, don't you think?
Yeah, you know, I do. The euro dollar has been, well, we cracked some pretty key support, and what's interesting is that we had the ECB minutes just come out about a half an hour ago, and although the market looked at it as being somewhat of a hawkish minutes, the pair still failed, and that's got to be a little bit of a concern for anybody who's long the euro dollar. Here, let me go ahead and take over really quick, and I'll show you exactly what I'm seeing. So, give me 1 second. Oops, sorry, didn't mean to show you guys everything. Sorry, of my first computer. Let me go over to just one screen. There we go. That's a little easier for you guys to see. Okay, so with the euro dollar, we broke below the 200 or the upsloping trend line, and that was a big deal. And people, we were talking about this yesterday, Dale, as far as you know, my hesitation about buying, and we were right here, by the way. Let's just go back to yesterday, and you can go back and listen to yesterday's video if you'd like for confirmation. But we were right here on the trend line, and I'm like, I have a little hesitation about buying the euro dollar right here while we're on the trend line because of the false breakout above the highs. You remember talking about that yesterday, Dale?
Yeah.
And I stopped everyone and I said, okay, if we have, you know, if you're looking at this chart, what do you guys think is preventing me from buying the euro dollar yesterday? And not everybody, but a lot of you guys correctly said that the breakout above the false breakout above the highs was more of a deterrent, and I feel that it is still today. And so we eventually broke through. We came through that trend line, and now we're at a very interesting place for longs. I mean, if you're long the euro dollar, you're probably starting to, you know, get to a point where you need to start making a decision, especially if you have poor positioning. You know, if you got in a little late into this move, you know, I still think, and I know I've mentioned this many a times, that the market is extremely long the euro. Sentiment is off the charts bullish, and it has been this whole entire year. So if you're poorly positioned in the euro dollar and you own it, you know, in the 122, 123 range, and you're a fund, you're an institution, you're probably starting to second guess your decision right now. And I do believe that if we break below 122, that is going to be very bearish for the euro near term. Now, does that mean the euro is going back to 115? No, I don't think so. But I think that if we break through this 122, we will get a clean break and retest the 121 level. I think this would be a very clean move through here. From a stop loss, you know, positioning squaring type of situation. And I think that's the risk right now. I think the risk is that we do break lower and just, you know, stop out anybody who is, you know, poorly positioned in the euro, and maybe, you know, allow for a recalibration of those positions.
I like that. I like that scenario outcome, Blake. You know, because that would wash out, I would think, some of the positioning of, you know, people being way too bullish euro, and then maybe we have that could end up being a great buying opportunity, just coming back and checking a major breakout. Great look.
Yeah, thanks. You know, and I know I mentioned this a few weeks ago. There's this one analyst that I was chatting with on we were chatting with in London, and he was at a conference in December, and this was at the beginning of the year. So this is like him and I were talking like January 10th or something like that. And he's a really he's not on Twitter all that much, but he's a rock star. This kid's extremely intelligent, probably one of the sharper younger analysts I've met and traders that I've met over the years. And he was at a conference in London, and he was just telling me the overwhelming bullish sentiment of the euro. Like, you know, it was more of the FOMO trade. You know, everybody from, you know, institutions to money managers to prime brokers to everybody. There was not one person that wasn't bullish the euro, and we were, you know, trading in the you know, 122, 123 range. I have to imagine a lot of people are really positioned with their books short dollar, long euro, and I have to admit that this, you know, this euro dollar to me still feels very frothy here, and the fact that we hit new highs technically and then reversed is very telling to me. So I think we're eventually going to move down to 121. I'm going to be a buyer down here, because regardless of if the euro dollar continues to move lower longer term, I think there is going to be some sort of reaction here. So here, let me draw that for you, what I mean by that. If we have a, you know, reaction from here, we could still continue lower, or, you know, maybe this will be it, and we just make you know, round the bottom, we start heading higher again. I don't know, but regardless, I will be a buyer at 121, just from a reactionary standpoint, even if it's just to pick up 50 pips or you know, 100 pips or whatever the case may be. You know, and then, you know, whether we get a continuation lower, it's really more dependent, I think, on central bank expectations versus in outlooks versus, you know, me trying to predict it from a, you know, palm reading or astrology standpoint. I'm joking about that, but you guys get the gist of it. I'm not here to try to, you know, figure out what's going to happen months from now, because I can barely figure out what's going to happen 15 minutes from now, let alone what's going to happen a few months from now. So, but really that's what I'm looking for in the euro dollar. And I do believe while we trade below this, you know, 123.50, this area, while we're trading below that, you've got to be alert for possible downside. Like I said, the ECB minutes this morning read pretty hawkish, and the reaction in the euro has been not hawkish and not bullish. So that is more of a concern for me. Now let's continue to talk about the dollar for a bit before I hand it over to Steve.
Also, Blake, I'd
yes.
say the biggest reaction came from stock indices yesterday after the FOMC. I'd like your view on that before you go, if you have a chance.
Sure, absolutely. We'll talk about that here. Let me just finish up a few
go
ideas.
ahead, buddy. You know, if I don't say what I'm thinking, I forget it.
That's because you're old, Dale. Just
Thanks for reminding me, partner.
Yeah, sorry. I'm sorry that I had to remind you that you're older than dinosaurs. But, but thank you. I will talk a little bit about the pound, or the S&P as well. So here's the pound, and the pound's really threatening an upsloping trend line here. And the pound, you know, I'm a little, you know, I'm a little nervous about the cable here as far as let me change this color of this line really quick. So I'm a little nervous about the cable here. It looks very vulnerable, and the pound's really, for the most part, been underperforming the euro dollar anyway. So the pound, I think, is at risk. Gosh, this squawk box will not shut up. Excuse me really quick. If you guys can hear this yammering of this Bloomberg guy, just blah, 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 blah. Anyway, it's it's intrusive to my train of thought when I'm trying to talk to you guys. I just want him to shut up really fast. Okay, apparently he's not going to. He likes to hear himself talk. So anyway, so we're probing some pretty key support here. Now I want to bring this to your attention because this is, I guess I'm gonna have to go out to a daily chart. If you look at the post-Brexit fall, this 130, you know, 850 level was pretty key, and we're getting close to that right now. But it's been a very big level of contention because that was the breakdown point. It was a major retest area. It was a major retest area on the way down, and you know, we may have overshot it a little bit, you know, on the downside before, but that's because I think it's such a big level. So here we are again, you know, facing this 138.50, pretty important area as far as I'm concerned. So if we start, you know, really making our way below that and getting a foothold below that, like on a daily, you know, daily close, like we close below 138.50, you know, closer to 137.50, that's gonna really threaten the pound, because the pound, Dale, we talk about this every once in a while. We talk about like the throw over, like we had a situation where we had this nice little channel, very obedient. We broke the upside of the channel but couldn't follow through, so that false breakout over there might produce some downside back to the mid 130s. So I think the risk is that the pound could possibly, you know, sell off if the dollar, you know, continues to strengthen here against the euro. Now the dollar yen, this has been, you know, my big this has been my big, real, just kind of trade that I've been really focusing on is just shorting the dollar yen or being long yen. So on these rallies, as we rallied back to this, underside of this major technical breakdown, I shorted the bejesus out of this thing yesterday, closed it in Asian trade at 107.24 last night. So in Asia, I closed my short right here because I got pretty aggressive yesterday. And then, I told the guys in Asia we'll probably get a bounce back to 107.50, which we bounced to 107.60, and we rolled back over again. And I was telling the people in our chat room. Now we've hit the 161% extension of this move. I don't know how much downside is left at this moment in the dollar yen without equities moving lower. So equities right now are fairly well bid. We've come off the lows overnight. If they roll back over, I think that the dollar yen then is, and all these other yen pairs, like you look at the euro yen, Canadian yen, Aussie yen, they'll probably come under some pressure too. And you see the dollar yen is actually probing 107 right now. So the risk I still think is lower. I just don't have any exposure dollar yen right now. I've been pretty aggressive in selling it the last 24, 48 hours, and I would continue to do so. One last thing I want to talk about before the S&P is the dollar Canadian. So the dollar Canadian, I sent out a tweet this morning. If you guys don't follow me, I'm at Pipsar, for those of you that don't know. The dollar Canadian is probing this downtrend line here, and we have the 200-day moving average right here. We have Canadian retail sales, which is expected a lot weaker than last month's reading, of course, from a seasonal standpoint. So we're going to get, I believe, January's numbers, which obviously are going to be a lot less than the holidays. But if they come in, a little weaker than expected, we have this potential of the dollar Canadian rallying, and then also, or the Canadian dollar selling off, the dollar Canadian rally, and then also tomorrow we got CPI data out of Canada, and if I recall correctly, last CPI print missed pretty good, and so if we come in shy of that CPI print again, for the second month in a row, this dollar Canadian could really, rip higher. And so if we clear this 200-day moving average, which comes in just above our highs, which is 127.20, we could see a really big move here. So I'm keeping a very close eye on the dollar Canadian. I've been bullish this thing as we came out of this descending wedge a few weeks ago, and it's been very well bid ever since then. Now let's talk a little bit about the S&P. And KJ asks, why don't I just turn down the squawk when I'm on air? Because usually they don't squawk and talk for usually they're just, they say a headline and shut up. And for the squawk guy to talk for 2 minutes straight is not that common, which of course it happens when I'm trying to talk too. But
now I see why they held last night. You had another channel line right there.
Yeah, this is that was speaking of the throwover. So this is our throwover in the S&P, and for those of you guys that don't know, longer term, why the S&P stopped where it stopped, we've been on this for a while. It was after the spike low following the couple months later following the flash crash back in 2011, we completed an AB equals CD move at the 261% extension. We turned decisively lower, stopped at this right here was 161% extension of this move. It's very technical and very well behaved too. We rallied to the 618 and reversed. I was chatting with one of my really good friends who's a very aggressive equities market trader, probably the best equity market trader I know. Actually, he is, I would say, for the amount of money he takes down. I don't know anybody else that takes down more money in the equity markets, actually. He was he was short S&Ps overnight. He goes, man, and then he covered a lot of it in Asia. And he goes, well, my feelings are, a lot of people went out yesterday in North American trade pretty short, so they're getting squeezed this morning, which is true. I mean, you look at the reversal candle that we saw in the S&P overnight, it wouldn't be surprising that so many traders are getting squeezed out at this moment. But I'm looking at the S&P as long as we stay below the 618, the highs from the last 2 weeks or whatever. If we stay below these highs, I would lean to the short side in the S&P. So if you see a rally, maybe another 15, 20 point rally in the S&P, I'd probably be a seller. If for those of you that trade equities, and I don't normally. So go ahead, Dale. What were you asking?
There's already a wick on this.
I can barely hear you, by the way.
Oh, really? Wow.
Yeah, I don't know. Maybe it's my mic, but go ahead.
There's already a wick on this bounce, and on the 1 hour, it got down to like 20 or 30 on the RSI. I'm not that impressed with the bounce. Right back to resistance so far.
Yeah, looking at the S&P here, we're at a 38% retracement. I mean, again, if we get another 15 or 20 points, in the S&P, probably be a better fade up there. You know how it is as soon as the North American markets open, they tend to buy stocks right out of the gate. So you might get a 10 or 15 point spike in the S&P to sell into. If it's possible. I wouldn't rule that out.
Everything.
Now I've got to get ready for this Canadian retail sales number. I'm going to pass it over to Steve, but before I do that, there's a lot of new listeners that came in through investing.com. We broadcast every morning at the same time. So same bat time, same bat channel for those of you that's an old adage, throwback to Batman. We're here every day at the same time. So
I'm going to put in the link.
Love to have you guys here. We do talk a lot of FX, but we also talk indices and correlations and I'm sure Steve's going to have something to say about the bond market, what's happening with yields right now. So with that being said, I'm going to pass over to Steve. Good morning, Steve.
Good morning, mate. I'm going to put in the link. So
you're on speaker.
I am.
Yeah, you don't sound normal. Is the same thing?
Okay, sorry. Is better?
Much better.
Sorry, wrong microphone. I have 3 of them selected. Yeah, my mistake totally. So what I wanted to say, that I'm going to put in the link. The only thing that people need to do to attend whenever they like every day, is register there. It's completely free. They just provide an email, and that's it. They receive a reminder every day.
Very good. All right, guys. Hey, good luck. I'm gonna check out. So good luck today.
You too, Blake.
All right. Thanks, guys.
Good luck, mate. Bye-bye.
Hi, Steve. How are you, buddy?
I'm good. How have you been, Dale?
Okay. Well, what did you think of the post minutes action in the market?
Something. People that were in the chat room, they know that we straightforward said that the statement was rather hawkish. And the initial reaction of the market was undeniably dovish because the dollar was getting sold off. But we made abundantly clear that the first reaction should not be trusted according to what we saw in the statement, because more or less everything in the statement was a tilt. There was a mention about perhaps, let's say, a delay to meet the inflation target. But other than that, everything was tilted a little bit on the hawkish side, which means that even having to do with inflation, everybody was confident enough that inflation is on its way to hit the target. And there was even the comment that came in a little bit afterwards that there was a discussion and a decision to add the word further, having to do with further rate rises needed this year, which obviously shows that when you're discussing something like that, you want to prepare the market to expect, at least what it had been already expecting, if not more. And that says it all, right? So it took some time for the market to actually interpret the statement on the, in the right way, but I think it did. And then we saw the reversals of the initial moves we had. So we got some really interesting moves. Stocks came down from the highs. The Aussie especially is the one that suffered more. I actually added yesterday when the Aussie was pushing higher once again. I added more to my position because, as I told you, I really believe that the statement was initially misinterpreted. And the USD CAD, Blake already showed that finally managed.
That
Yes?
screen that you have right there, okay? If viewers,
Sorry, I just wanted to say we got very weak CAD data, retail sales very weak.
Yeah, I see that here. That's why I switched to that as well, because I saw it, and we're actually now pushing above the. We got minus 0.8, if I saw right. Correct, Stelio?
That's correct. Yeah. Correct.
So we were expecting, if I remember, 0.1 or something like that, or flat. Yeah.
Expected flat. Yeah.
Minus 0.8. So yesterday, one of the things we said in for the USD CAD, and as you see, I had already interpreted this as a bull flag in my charts. We were saying yesterday that if we do close above 126.60, I think that 127.80 is going to come really fast. And as it seems really fast, is going to be most probably within less than 24 hours. Because we were having this discussion yesterday when after the FOMC minutes, we got the initial reaction, and I said that, listen, if it stays below 126.60, that's fine. I mean, it remains somewhat subdued, but if we actually manage to close above 126.60, in my opinion, 127.80 is going to print very, very fast. As it seems, if we get some follow through today, that very fast is going to come like within less than 24 hours. So the levels are quite clear here. This has been a very technical move. We had the descending wedge, we broke above it, we saw a correction down to an important support area, then we also formed like a bull flag. We broke above it yesterday, the day before yesterday to be exact, and we broke 126.60. We're on our way to 127.80. If we break above that, the next area of resistance is the 129 to 129.20 area, and after that 130. So until we see some change of behavior, we should respect this break above this descending wedge. And why not, even if you see it from an Elliott wave perspective, and there is a chance that Greg is going to be with us very soon. He said that he's going to try to make it either today or tomorrow. So he can definitely give us his view. But even if you see this as a corrective move, we can easily have an ABC, and which means that we can even see a push above the previous high, perhaps towards the 61.8 before we resume the move lower, right? So bottom line, of course, our medium to long-term bearish dollar bias has not changed, but as we've said plenty of times, and and everybody that hears the webinar knows that, especially when we were pushing to new lows, we were making very clear that people should not embrace this dollar weakness in the short term, because the risks are for a stronger rebound. We see that especially against several pairs. So, the dollar has been strengthening against some pairs, not so much against others. Now, just let me show something briefly before I cover some other things, and then we can go through questions. I have a little bit of a different technical view here. Blake was checking of another trend line, but I have to say that I also view this as an ascending channel. You've seen me show this. So keep in mind that the Euro USD is currently testing. So far today, we've seen a spinning top exactly on channel support. So be a little bit careful here, because this can provide some lift, can produce some lift from here, but we'll see. Regardless, I think that the key level here is 121.60, 121.70, and then 120.60, which is extremely important, because that was the high we found in September. It acted as a resistance briefly when we retested it once again. So in my opinion, as long as we remain above 120.60, you should not really be overly bearish the Euro USD. Now, we had a brief look at the Aussie, and I have to say here that having to do with the Aussie, we have a target, at least a short-term target, that looks technically very good, because we had said that a break below 0.79 is probably going to push quite significantly lower. Now, where that lower is, we have a very nice confluence of supports. You can see that this 77.40 area, if I zoom out, you can see how important it has been, on this chart. And this is also now the 61.8 of the last move higher. So I think that this area has, should act like a magnet. So I'm pretty much confident that we should see a retest of that area. Now, can we break lower from that? Of course we can, but I would first want to see a test of that area. Probably I would book some of my profits there, and then if we break below there, I think that the situation becomes quite more severe for the Aussie. Now the Kiwi, as we've shown several days, is holding much better. So obviously, if you want to be long, you'll be long the Kiwi. If you want to be short, definitely the pair of choice between the two of them is the Aussie, no questions asked. But let's have a look at, Blake already showed the short-term rejection in the USD yen, so I don't have much to add here. Obviously, another move lower to retest the 106 area is quite likely, especially as we remain below this broken triangles support, which might easily act as resistance. You can see how important this is. I mean, this dates back to 2012, at the very beginning of the USD yen uptrend, in expectation back then of Abe and his new monetary policies and Kuroda. So the fact that we broke below this trend line is extremely important. But let's have a look at a few yen pairs. Okay, so especially I want to focus on some of the commodity currencies against yen pairs, because I think these have provided us with some very interesting technical breaks, right? So this is the Aussie yen. Now, if you look at the big picture, somebody can easily interpret this, a large correction, to the strong move lower we had from the end of 2014 to mid 2016, right? So even if you see at the structure, the fact that it's slow, it's choppy, it's overlapping, definitely does not point to impulsive price action, right? So the fact that we've been now breaking below this trend line, which has acted as support since the very beginning of this, let me say, the corrective move higher, is quite an important development, right? So I think that this technical break is one of significance. And if you look at the Kiwi yen, more or less, you're going to see an equivalent situation, right? Obviously, it's been holding up somewhat better for reasons we've pointed to the Aussie Kiwi as an interpretation, but still, it's quite heavy. And if you have a look at the CAD yen stalled briefly at an area that you would expect it to stall, but look at what it produced. I mean, it produced like a very soft bounce the first day, and then the next 2 days were gravestone dojis. So sometimes the candles just tell the truth, because if after such sharp move lower, within, let's say, 3 days of consolidation, you manage to produce like a small white candle and then 2 gravestone dojis, and all that on the 61.8, which if you zoom out, you can see that this has also been a horizontal area of support resistance, or as other people want to call it, a demand supply zone. So the reaction to that was, extremely weak, and obviously it has now failed spectacularly. So just look at this move lower. I mean, this looks impulsive to me right now, and keep in mind that this also comes after a clean inverted head and shoulders formation had been formed here. We broke above the neckline, and then we failed. We came up, we tested the highs, and the pair just collapsed after that. So I'm pretty sure that there were a lot of people that got trapped here being on the wrong side of the market, because interpreting this as an inverted head and shoulder formation was a valid thing to do initially. But once you see the breakout and you see that there is absolutely no momentum, you can then understand that probably the interpretation was something very close to what we saw in the Aussie, in the Aussie Yen, which was something like that. So bottom line, the interpretation was that this was also a corrective move higher, right, to a strong downtrend. So now that this corrective move higher seems to be over and we've broken below this trend line, I think that there can be quite a significant follow through coming here. And I think that all those yen pairs are actually sending warning signals, and given their usual correlation with risk, they can also be sending warning signals to risk. If you remember, one of the elements that we were looking for, seeking a reversal in indices from the end of December until the end of January, when we actually saw that, was the fact that USD yen was not playing ball anymore. Among other things, among the fact that the correlation between VIX and the S&P, for example, had become positive instead of the usual negative correlation, and some other things that we were showing here to our viewers. We were even eventually mocked by a few people saying that, you'll get chopped up if you try to short this market. But there were a lot of signals that something was brewing in the market. So now, what do we do from here? I'm just going to briefly repeat what we've said plenty of times. In a choppy range between the highs and the lows, I wouldn't rule out even a push to new lows from here. But definitely, even if you're bullish and if the market continues to be bullish, which is a high chance given the prior multi-year bullish trend, don't expect a push to new highs like within a matter of a few days. The market has to first get over the jitters that this abrupt move caused. If you saw, the outflows from ETFs were a record high last week, so there were a lot of people a lot of weak longs that went in the market, got immediately scared and left the market. So I do believe that the recovery and the push to new highs will need, at the very least, some weeks to happen. Now, let me have a look at a few questions, and if Grega makes it as long as we're here, fine. Otherwise, we're going to hear his opinion tomorrow. Stelio, by the way, can you please put on the webinar the link for people to register?
Yes, I will. And also, we have Jose who's asking when is Michael Huddleston speaking? He's the guest today, in probably around 15 minutes from now.
Yes, at the top of the hour. The interviews are always at the top of the hour. Exactly.
Yeah.
So in 17 minutes from now. Correct. Okay, a question if the Kiwi is following the Aussie or if it's in its own path. It's definitely stronger. I mean, the Kiwi is definitely stronger, and we've shown the past few days the reason, and the reason is that the fact that the Aussie Kiwi has been breaking lower. So the Aussie Kiwi was our guide that helped us, look for shorts in the Aussie instead in the Kiwi. So as long as the Aussie Kiwi is weak, and as long as it remains under pressure, I would advise that if you want to be short of one of these commodity currencies, that you should be definitely looking for being short the Aussie, either if that's going to be against the yen or the USD or whatever other currency you're looking for. We were monitoring at this 1085 area of support. It held multiple times. The 200 DMA was also there, but when we finally broke below it, we drew this. We said that, listen, this area should act as resistance from this point on, and that's going to be a good opportunity to be short. And this is exactly how it worked. It even actually worked much faster than we initially expected. And I think that there is a lot more downside because the next actual area of support here is 120 pips below where we currently are. So I think that the Aussie Kiwi, has more to move to the downside, or anyhow, it can potentially very easily move more to the downside. Pound CAD, let's have a look at it. Haven't had a look at it in several days, I'm pretty sure. Here it is, and this is the last time we saw it. And I remember now that the last time we saw it, I said here that, listen, this is a textbook triangle. I remember another friend had asked for it. I said that, listen, I'm not particularly fond of the price action, meaning that, yeah, we are definitely in an uptrend since we got that inverted head and shoulders there. But on the other hand, the price action is not like spectacular. But undeniably, we had a triangle, and triangles are formations, as I've said like hundreds of times. Triangles are formations that in the vast majority of the cases break in the direction of the previous move, so in the direction of the trend, and the short-term trend has definitely been to the upside. And as you see, the triangle did break to the upside, and we're currently testing the 38.2 of the larger move lower. So if I zoom out here, you're going to see that this is quite an important technical level. If I zoom out, you can also see that, more or less, this was an area we got a high there, roughly 1 year ago, 10 months ago, let's say. Roughly, that was an area that we got some lows here in 2014. So, quite a significant area. Now, if we break above here, which is quite likely, the next area of resistance is going to be where we found the double bottom momentarily, briefly, back in 2016, and that's going to be roughly at 121. So that's not, we have some distance to that, right? It's like roughly 400 pips away. So if we break above this 38.2, I think there is, there is potential for more upside here. And keep in mind that, in the medium term, not in the long term, but in the medium term, we remain in a well-defined uptrend, right? A series of higher lows are, telling of that. Okay. Let me see what other questions we have. Can you explain what swap trading is? Swap trading? I have first time I hear the term. Stelio, I don't know if you've heard the term before.
I have not, no. Sorry.
Yeah, same here. Okay. Do you see the pound heading to 136? It's quite likely, and it's quite likely, and even if it does, up to that point, it will remain bullish. I showed that yesterday, but let me show it again. Okay, whenever you have some corrective price action, first of all, you can never be sure in advance what kind of form that's going to take. So, for example, what we're now seeing might end up being a triangle, something like that, let's say, right? Or it might end up being a bull flag. So even if this ends up being a corrective move lower, which, let me be very clear, for the time being, we have no reason not to interpret it as corrective price action, given the fact that since we found lows post-Brexit, we had series of higher lows, and that has not been violated yet. So, given that fact, and given the fact that we haven't seen any strong impulsive moves to the downside, I would say that even if we just see a simple ABC to come down to retest this 136 area, this will still be looking good for another push to the upside. So bottom line, we are correcting lower. I yet see no reason why to interpret this as anything else than a corrective move. But yes, there is space to push lower towards 136, 136.50. We might find support earlier than that, absolutely, because as I said, there is also the possibility of a triangle interpretation. But if we go down to 136, I would be extremely careful if I was short. So if for some reason you shorted here or there, you did very nicely. You can trail your stop loss and hope that we will actually push to 136. But in all honesty, down at 136, I would become very, very worried unless we've seen some strong acceleration and some impulsive characteristics to move lower. I would probably be covering my short and be looking to trade it the opposite way, right? Now, having said that, a friend here is asking about the DXY. Let's go have a look at it again. The DXY remains more or less in no man's land, but as we've said plenty of times, that doesn't change the fact that if we actually break above this high, and especially above 91, which, as you can see here, is a significant area, then we should see the dollar squeeze higher. So as long as we remain in this area, anything can really happen. And you should respect the larger trend, which is to the downside. But in all honesty, you should be very, very careful because we know that sentiment and positioning are quite extreme. I mean, bearish extreme, having to do with the dollar. And a move above 91 will start triggering some stop losses. Needless to say that if we see a break above this area, which hosts multiple resistances, the 61.8 retracement from the high that we found, the corrective high here, it's the descending trend line from the highs. And what else is it? Yeah, it's also horizontal support. You can see that how important it has been in the chart here. So especially if we see a move above there, I really believe that the dollar can squeeze a lot higher and still just produce a larger correction, right? So I understand why somebody wants to continue being short the DXY, but you should really be careful because, as I said, if we start trickling above 91, then it can produce a snowball effect that will slowly accelerate, especially if we manage to break above 92.50. Okay, so keep those things in mind. Let me see what other questions we have. Yes, a friend here is asking, how long can I have access to this webinar afterwards? Download preferably, but streaming is fine. This way is very helpful. Thank you very much. You absolutely can. You can just go to YouTube. And in YouTube, you can just Google ForexAnalytix. You can just search for ForexAnalytix, and you'll find here the ForexAnalytix channel. Here it is. Everything in categories is posted here every day. So, for example, maximum a couple of hours after the webinar is over, it's going to be posted there. The interview is also going to be posted there. Some other videos that we do, like one video that we do every Sunday night that has to do with a view on the week ahead is posted there. And everything that has a video form goes up to our YouTube channel. And everything is accessible for free, of course. Okay. Euro pound. Yes, Telio?
We have another friend, Ernest, who's asking if we have any trading classes or free resources. At the moment, we have an education page, which is free. So if you go to www.forexanalytix.com, you see a link that says education, where we describe the various types of analysis that we use. And soon we're going to be, within this year, we're going to have a video store, but that's not going to be free. But you will have access to a lot of videos and resources that can hopefully help.
Absolutely. Absolutely. Now, I have a question about the euro pound and about metals. So let's have a look at them all. So first of all, euro pound, I'm afraid that I have to keep repeating myself that nothing has really changed about this. As you can see, the euro pound has been extremely frustrating. We saw a move that we interpreted as impulsive to the downside, but what followed since has been a very choppy more or less we can call it a range, although it's not a range. It's a slightly descending channel that has capped price action, and definitely you can see that many attempts could be made, hoping that it's going to move higher or lower, but none of that has happened. So in my opinion, to see some important follow through, we either need to see a break below the 61.8 here and the two lows we found here, let's say at 86.80, or we need to see a break above 89.30 to get some follow through. Until that happens, you can even see it from the 50 DMA and the 200 DMAs that have converged, and from the RSI that's mid-range. There's nothing to do here, I'm afraid, right? So we just need to remain patient until the market decides that it wants to finally start producing some momentum, because there is none at the moment. From a larger technical perspective, I would favor a resolution to the downside. Okay, so let me say that I would favor a resolution to the downside, but that doesn't mean that I'm going to be trading it, especially when we've been trapped for so many months in a range. I will trade it happily if I get a confirmation that we're breaking lower, because I do believe that if we actually manage to break lower from there, there is a very high probability that we're going to come close to 0.83 once again. So there is going to be a decent amount of downside to try to capture afterwards. But as I said, until we get a break to either of the two directions, I think that you should rather remain sidelined, having to do with this specific pair, and remain patient so you don't get chopped up trying to trade something that doesn't want to go anywhere. Now, having to do with metals, we had a look at them yesterday as well. Gold remains in a large consolidation after a strong move higher, so I cannot easily interpret this as bearish. I think that silver is a little bit more clear at the moment, because it definitely remains, as most of last year, etc., somewhat weaker. But given the fact that if you zoom out, you can see that both the metals have been in large ranges for long periods of time, I think that you should probably attempt to trade them, shorter term and not longer term, because they have both been producing strong moves to both directions. So they are quite keen in in trapping you and getting some money out of your pockets, ending up doing nothing, or anyhow not much besides shorter moves. Now we have a question about the pound Aussie and the pound Kiwi. Nothing has changed since yesterday. The pound Aussie is still holding this ascending channel, but in all honesty, the price action definitely doesn't show that we have like some strong upside momentum. So respect the upside, because we have been respecting it since we found the low like in September 2017. And especially as long as we remain above this broken triangle's resistance. But on the other hand, I don't know. Personally, I think there are better opportunities out there. And the pound Kiwi, more or less the same. This can be interpreted, bullishly if you view this as a triangle above this broken large bottoming formation. You can call it another triangle. But I think that the lack of upside momentum definitely says that you should at least wait for a break above this trend line to then look for acceleration to the upside. So currently we are above this very important broken trend line resistance that can potentially act as support. It did so in the recent past, and this trend line resistance. So I think that being in the middle of this range, probably there is nothing to do. Just keep watching and see if we're going to get something to do later. Do you think Euro Swiss will break higher? Okay, actually we were very closely monitoring Euro Swiss. Whoever is here already knows that we were very closely monitoring Euro Swiss since it was in this channel, and I had warned very early that break above there would probably push the Euro Swiss sooner or later back to the broken floor at 120. But on the other hand, then we saw a very clear ascending wedge before reaching 120. And then is where we warned that be careful, because this is clearly an ascending wedge. And if we break below it, that's what we had drawn, that we're going to see some acceleration, perhaps to go down and retest the 200 EMA, if not lower, down at the beginning, because, you know, from a technical perspective, ascending wedges, you know, you expect that they might retrace back to the bottom of the wedge, so down to 112.60 in this case. Okay. Now, we've broken below here. Obviously, we haven't seen something impressive having to do with follow-through, but as long as, you know, we stay below this descending wedge and we do not start breaking and, you know, posting some higher highs. So, for example, unless we see like a move above there, I really think, yeah, that there is a potential to move even lower from there. Now, generally speaking, do I see the potential of pushing higher once again? Absolutely. Absolutely. And I think that if risk appetite stabilizes somewhat, I think that the end goal that we had in mind when we were breaking above there at 109, which is going back and retesting the broken floor at 120, is easily doable. It's absolutely achievable.
Thank you, buddy.
My pleasure. My pleasure, Dale. I guess that means that we ran out of time, right?
Yeah.
Okay.
Great review as usual. You could, Steve's in our private chat room a lot during the day, sharing his charts and views. One of the most disciplined traders I've ever met. So we have a great guest today.
Enjoy the interview, Dale. I know that a lot of people are looking forward to it.
Yeah, I am too. So, Michael, welcome to FaCe. I'm going to make you the presenter now. And looking forward to hearing your voice and seeing your screen. If you have any issues, let me know. There's a screen for Michael.
Can you hear me, Dale?
Hi, Michael. Great to meet you.
You as well, sir.
Thanks so much for joining us today. Your reputation precedes you in here. You know, I also like to bring on a lot of people that aren't well known to lift them up, give them visibility, because I'm a believer that it's not always the famous that are the best.
Right.
And sometimes it's the people that no one knows of that are great traders. Sometimes the famous are just great marketing people like me.
Mm-hmm. There you go.
So great to meet you and have you here. You're a mentor of mentors, because I've interviewed one of your mentees, Saeed, and he gives you credit for, you know, teaching him, and the response on Twitter was pretty big. So you have quite a following. So I'd like to start before you had a following, when you were just looking into the markets and how that happened for you. Did you have mentors? So why don't you jump in a time machine, buddy, and tell us about the beginning of your journey into trading.
I started in 1992. November 5th of this year will be 26 years for me as a follower of the markets.
Okay.
I had an uncle that was fortunate enough to make some money in the sugar market as a commodity trader, and coming from a modest upbringing and a very, very low income bracket household, he was the highest net worth individual in our family, and everyone wanted to have the things he had. And he used to always tell me, you know, the richest people in the world are futures and options traders. So when you get out of school, get yourself a good career, make some money, and start trading. And as a 16-year-old, I really wasn't interested in hearing that. But when I got out of school,
you were just getting your driver's license, and you could go and pick up your girlfriend.
That's right.
Yeah.
But it wasn't until actually I became a working adult and hated life. I didn't want to be working for someone else. It just wasn't for me.
What were you doing? I'm just curious.
I was actually filling candy machines and soda machines and coffee machines. I was a vendor. I'd go around and do a vending route.
Yeah.
And I worked about 13, 14 hours a day. And
Yeah,
it was,
that could motivate you to want to learn how to trade.
especially for $183 a week, it was it was bad. It was really bad.
What a great story. So you actually had, you know, people write books and make fun of it. You had a rich uncle, and you had some good, he gave you some great advice early on. So did he also, when you were finally ready, did you work with him at all, and did he teach you anything?
Actually, he had like more or less like a one-shot wonder type event where he made money in one market and was never really able to repeat that.
Okay.
But I held on to that idea that if he could get lucky, there has to be someone out there that's doing this consistently. And I got inducted to trading by much like everyone else in the commodity markets back in the 80s and 90s by way of Ken Roberts.
Oh gosh, 1, 2, 3 bottoms. Did you? Right. Did you? Yeah. and the cowboy hat and
cigar, the whole show. Yes.
Yeah, all of that. See, that's what I was talking about. Some people that are famous are better marketers and traders. So, Ken Roberts. Then you're from the era where you probably used to keep up your charts by hand, like use commodity perspective.
Yes, we used to do open, high, low, and close. You used to draw them out and used to update our indicators. It was all by hand back then. So,
yeah. Wow.
Some of my students, they don't like to think of it like that. They're used to high touch, high tech of their smartphones or computers, but we didn't have that back then.
Okay. So from Ken Roberts, talking 1, 2, 3 bottoms, which are really either ABC or 1, 2, 3s. What was your next step after Ken?
Well, as a result of buying his material, I got on a mailing list of Larry Williams, and it wasn't until I got in touch with his marketing team, and they offered some things. I purchased whatever I could get from him, and it was about that time I started finding a little bit of a rhythm. But I only understood buying or going long. I didn't trust the idea of going short. So my initial foray with commodities was a loss with an orange juice option. And I was trying to do a 1, 2, 3 formation based on some recommendation by Ken Roberts, and it was wrong. But long and short is, as fortunate as I was to be inducted to this industry by someone like Ken Roberts, and I'm thankful for him. I wasn't able to make any money with his material, but I'm thankful for him that he allowed me to get in, the rotation of eventually finding information that was useful to me, and that was by way of Larry Williams.
Okay, all right. So I usually ask this question: how many years did you search and work and screen time before you made some type of breakthrough epiphany to where you said, I do know how to do this?
Well, I had initial luck after getting with Larry Williams. Everything was in a bull market back then. And I was able to catch a big move in the Japanese yen, big move in the coffee market. In 1995 in July, I caught a big move in wheat. And that was the one that retired me. I didn't really do anything after that. And I thought I knew what I was doing then, but I actually didn't. I actually over leveraged a lot. I didn't really understand money management. And all it would have taken is a small real retracement on the wheat market that day I actually decided I was going to be done working. It would have wiped me completely out. But
Did you ever blow out an account, Michael?
Oh yeah, absolutely.
Okay, I mean, who hasn't?
Right. Anyone that says they haven't, they're liars.
Yeah, most have.
Yes.
Even the guys I know that really pull money out of the market nowadays, they all experience that. How did you make a comeback after going through something like that's more serious than a drawdown? Drawdowns are just part of the process, but blowing out an account psychologically. How were you able to recover and have the courage to give it another go?
Well, I had to more or less eat crow because I went from a humble, quiet disposition to a braggadocious arrogant individual. When you start making big money, it's hard to keep that in check as a young man. And
Yes.
I was humbled back then. It was very humbling for me to admit to my closest family members that, you know, I had a lot and then I lost a lot. So
Yeah.
it caused a lot of anxiety. And for me personally, and I know maybe some of your viewers won't subscribe to this view, but I turned to God. That was my fix. So it fixed a lot of things mentally for me. So from a psychological standpoint, it didn't matter to me if I was successful. And when I stopped worrying about the money and just keeping a low end, you know, objective, all I was trying to do was make $1,000 a month and retire by 40. And over time, that became realistic. It became easy. And for months, you know, I could have been doing a lot better than I was initially. And then I started understanding money management and applying more. And then it just grew from there. But I would say it wasn't until about 6 years after even being profitable, 6 years until I knew exactly what I wanted to do to be consistent. Because I would always chase something new. If Larry Williams put out a new book or a new, you know, indicator or a technique or something, you know, I was buying it hook, line, and sinker. And I'm not trying to disparage anyone from doing those types of things because it helped me become the trader I am. But, you know, there's a lot of things that we go through as a developing trader and we ingest as far as supposed knowledge or insights, and it really isn't helpful at all. It feels like it is because we're doing something, and that's what we want to do as traders. We always want to be involved in the marketplace. We want to be engaging somehow. Otherwise, we feel like we're wasting opportunities. And when I found the setups that I like, it became crystal clear to me what I want to be doing. And if I didn't see them in the chart, or the probabilities for them to form, I really wasn't pressed to get into the marketplace at all. And it created a different mindset and a paradigm shift from that of that is taught by books. You know, they teach you to be an action hound. You know, take your setup, push your edge. No, those things didn't work for me. When I took a more relaxed approach.
You found out less is more?
Absolutely, and that's what I preach. You know, it's not the quantity, it's the quality of the things that you're looking for.
Can I make one comment? You know, not many people bring up that, you know, they went through some type of conversion experience through trading and being broken in that way. But you ever see that painting of a shepherd that's carrying a lamb over its shoulder?
Yes.
Okay. In the old days, the shepherds, when they had a stray lamb, what they would do is break one of their legs and carry it around that lamb until it healed. And then the lamb or the sheep learned to always depend on the shepherd. And so sometimes that's what God does to us. You know, he breaks our leg. So, you know, I think that I appreciate your openness on that. So why don't we get to what most people are interested in, and that's money. And tell me what you see happening here in the Dixie. What I see, you have no indicators, some squares, some lines. So you trade pretty naked. I hope you keep the shades drawn.
Yeah, I do incorporate some things on my chart, but it's not like an indicator like you would see from a platform or anything like that. I do make notations with like rectangles just to draw out an order block, or I draw a reference to a specific equal high or equal low where there would be a stop. But as far as the dollar index, you know, I'm looking at the equal lows that we had in here, we just pierced through.
Yeah.
The obvious next level of liquidity is going to be above these highs in here. And then we have this inefficiency right here. Okay, and right above that, we have that old high, I'm sorry, old low back here. So from a traditional support and resistance standpoint, I think there's a lot of value for that to come back and play. So around 90, 80 to 91 big figure. It would be interesting to see it come back, at least at the minimum, go back above this high here. Because if this continues going lower, and honestly, I think the dollar is going lower. I see 87, 85 in the cards if we can reject once we get back above these highs in here. I mean, we got a pretty good mature downtrend going on in the dollar now. So it's not unreasonable for it to come back up in a deeper retracement, knock out trailed stop losses for anyone that would be bearish on the dollar now, pick up some more liquidity. and then make another leg lower. That's my expectations.
What would change your mind that we're not going up there, and perhaps we don't take out 90.50? What would be the first indication or trigger that that scenario is not playing out and we're going to new lows, perhaps your 87 level you were talking about earlier, not later, but maybe from here? What would tell you that?
To make sure I understood your question, what would negate this idea I have in mind here? Is that what you're asking?
Yes.
Okay. If we failed to stay above, let's say Thursday, Wednesday, Tuesday, if we stay above Monday's high, as long as we're staying above that, I think that's what's going to happen. If we lose Monday's high, then we're probably going to just roll over. But to me, it's just too deep of a retracement to just stop here.
I hear you. Okay, so great look. And your longer term bear, is this the main instrument that you trade, or are you a portfolio trader? Do you have several positions on at the same time? What would you say is the max amount of positions that you have on, or different instruments that you have on at any one time?
Well, I'm primarily a fiber or cable trader. I use the dollar as like a barometer, tells me what I think I should be doing from a macro standpoint. But I only trade one.
Cable. Why did you select cable as your main instrument for trading?
I traded a lot as a futures trader. I transitioned from futures to solely FX in 2006. So I haven't really done any other asset class since 2006.
Okay. And so what's your take on the pound? Let's go to your bailiwick and talk about it. Lately it's been underperforming the euro. So I'm curious as to what your take is here. Now, to me, it looks somewhat positive. Are you in the same camp?
Longer term, I believe we're going to take out the high here.
Okay.
My concern is do we need to come all the way back through and clear up this inefficiency? I don't want to see it do that. It certainly is kind of like all of this price action is really just standing on top of this one candle. Now,
why do you call it inefficiency? They're large, directional, impulsive candles. What's inefficient about that candle?
Okay, from a standpoint, I'll give you a contrast. What we learn as retail traders from textbooks, teachers, gurus, and educators, price moves because of an indicator. Indicates that price should go higher or lower based on overbought or oversold, and that's not true. What the market does is it seeks liquidity, and when the market's being driven, there's engines that produce the market's movement higher or lower. And once these engines start delivering price higher as a market rallies like this, price will skip. Not every single one of these price levels will be offered. So kind of like as a futures trader, and you can appreciate this because it's a gap.
Okay, like air pockets on the way up.
Exactly. I like to use the analogy of a paint roller. Okay, imagine if you had a paint roller and you applied paint to the wall, and you start the roller to the wall here and you start rolling it up. In the first couple inches, it's going to be a real rich layer of paint. But as you keep going higher, it's going to start getting pockets where the paint really wasn't delivered that well, and you got to go back down to it, fill it in. That same thing happens in price action. So if we look at price action, and this is something your listeners can do as an exercise, it doesn't matter what time frame you do this in, but if you look at every single time where a up candle, the longer the up candle, better. Okay, you don't want to do it with like little short stubby candles, but the candle, if it's long, take your chart, print it out, and take white out, or kind of like block it out, and watch over time how price will go back in and fill that in. Now, as a futures trader, we had the gravity of closing.
Right.
When prices would close and the next day's opening, there would be a difference between that, unless you looked at the Globex market. Well,
yeah, we knew how to trade gaps. They just don't happen much in FX because of 24.
It's a 24-hour, right? But they still exist. They still exist, and the inefficiency is that price has not been offered on both sides, buying and selling here. It's been an imbalance of only buy side delivery offered. So price will inject volatility on the upside, but the sellers really didn't get a chance to do too much in here, and the buyers didn't really get a good chance to buy at all the levels that were offered in the open to the close. So if you look at every single time that the market will want to retrace, well, if you look at this here, this down candle here, we left this high here. Let me zoom in a little bit so you guys can see it. Let me do it one more time. All right, so we have the market rally up, take out this old high here. I don't really concern myself with the wicks. So we have a slightly higher high here, and then we rejected that. This down closed candle, just think of it as that paint analogy.
Okay.
It's been offered on the sell side, then the next candle it opens, and then it goes up a little bit, and then drops down. So these two candles have only offered what? Buy or sell delivery. Only sell delivery.
Right.
So the imbalance is it's only been selling, but where's the imbalance really stopped? This candle right here, where its low is, the next candle here, that open. At that open to the high, that's when buy side delivery was offered. So the imbalance ends at this opening. And you can see the bodies of the candles stopping right there. See that? So the market retraces up to that price point perfectly. It's precision. And then the algorithm will allow price to start dropping lower again. If you look at these inefficiencies, and there's a lot of things that go along with it, I'm just giving you one element, very simple approach to it, but it's even more radically precise than what I'm showing you here. And it's on every time frame. So the key is, and this is what I've done over the last 15 years, is look for opportunities where price will have these inefficiencies on a higher time frame, and it creates like a magnet effect. And if I can trade in that direction, I don't look at trend lines, I don't look at moving average crossovers, even though I've used them to teach the concept of momentum from on a higher time frame basis. I use imbalances and liquidity pools, which is stop runs, really to frame all of my trade setups. So either I'm trading inside of a range or I'm expecting the range to be broken from a directional standpoint. But
okay,
it really is all hinged.
I mean, that's great stuff, Michael. In fact, someone in our community, LaShawn Turner, is asking if you can show your ICT order block. And, you know, if it's proprietary, I understand, but she said it's very fascinating, the ICT order block.
Okay, and that's pretty much what I'm known for. When I stepped out on the baby pips, that was like the first thing that everybody gravitated to because they could see something and it wasn't relying on indicators. The problem is, at first glance, it looks like supply and demand, but I don't stop with just the most recent level. Like they'll teach like only use fresh levels and don't cut through candles. Well, if you don't cut through candles, you won't get the breaker. Okay, and I'm going to amplify what she's asked for, or he, I'm sorry if it was a man or female, I'm not sure what who asked, but these up close candles, okay, we're looking at a daily time frame. So if we had a way of forming a chart, creating one candle for every 3 days, this would be one singular up candle. Now this candle, or series of up candles, is all one order block. Now, what is an order block? An order block is where large institutions, banks, they will sell into that rally. Large institutions have rules. They cannot sell short on down moving markets. They have to sell short as it goes higher, and they can only buy when it goes lower. That's the only way they're going to get their pricing, and because their sheer order size, it requires them to do that. So the order block theory is if we see price rallying up, and we're taking out old highs here, if it rejects, I don't need to know that it's going to stop here. I don't try to pick tops and I don't try to pick bottoms. I want the institutions to leave their telltale signs and hallmark signatures in price action. So while I have already shown you the inefficiency and the rebalance at this opening here, because the wick offered buy side, anything below that is again all sell side. Well, we see the balancing of those orders right here, and then look at the reaction we got there. Go further, cut through this candle here, okay? And you'll see these up close candles. What's happening here? Well, anything that was residing above these opens and closes on these candles here in the form of a protective stop, they're running them out. That creates this as a breaker. Now, I teach two styles of breaker. Breaker is basically breaking the market structure. Anyone that was short that had to stop above these bodies of these candles here, they have been neutralized. They can, they're not in there now. So when the market goes down, exactly. So now my eye goes right to the bottom of this candle right here, the body, not the wick. I'm looking at the body of the candle here. When price trades back up to it with these candles here, right when we hit this here, we are in sell territory. I'm going to start looking for reasons to go short. Now, this is where everyone looks at my information and my free tutorials, and they just think every up close candle is a bearish order block, or every down close candle is a bullish order block. You have to apply some context, and I'll give you some more context and apply what I already showed you. This is the stage. This is a bearish order block. But inside this order block, there's going to be an inefficiency that you have to use to set up the signal. This is the opportunity, but it doesn't form until you get to this level right here, where we described where it was only going down. Well, when price starts trading up these up close candles, it goes right to the opening of that candle and stops right about that same level, goes a little bit with the wick, but then we have delivery on the downside. This element of price delivery is where institutions come in and they do their buying and selling. It's not based on indicators. It's not based on trend lines. It's not based on any of those things. That's all, red herrings to get you thinking. And once in a while, they do work like anything else, but that is what's sold to us as retail traders. We buy all these books, and I own over 2,000 books. I've read every single one of them, some of them twice, in hopes that I'll understand the markets better. And literally, I have a checklist of maybe 12 books out of all that I think is useful. And most of them aren't really indicator-based things. They're all the way you think about the market.
Okay, name a couple.
Well, Trading for a Living, not the stuff that's technical. Okay, Alexander Elder's book about the way he kind of like draws the contrast between an alcoholic and a loser's mindset. Okay. I gravitated to that. I've never drank a drop of alcohol in my life. I've never taken drugs, never done anything like that. But I grew up in that environment. And the way my family interpreted what I was doing in the markets, they said I was going to be a loser like them. Yeah, it's gambling. Yeah, it's a pipe dream. Right. Well, they're all asking me for money today. They're all working. I don't go to work. I'm talking to you today. So, and it sounds braggadocious or arrogant.
This is fun, huh?
Yeah, but you have to discount those people.
You want to go back out and fill up a candy machine today, Michael?
No, I don't want to do that anymore.
All right.
I don't want to do that.
Got some fascinating stuff. Now I know why you have such a following, Michael. So you were published. Your work's all over the place, and you have a YouTube channel, because on Twitter, there's no website. There's nowhere to find you. I don't see you tweet much. So, I'm sure, besides your fans that have been here today, that there are new people hearing you and will hear you on the video. What's the best way for people to stay in touch with Michael Huddleston?
Well, the best way is obviously through Twitter. That handle is I_am_ICT. I keep everyone up to date as far as what I'm doing there. My website. And
let me ask you about Inner Circle Trading. Is it trading or trader? How did you come up with that handle? And what was it? Did you at one time have a formal website and teach people, and you had enough of it and you just want to be left alone and do your own thing and make a video once in a while?
Well, I started calling myself Inner Circle Trader as a kind of like a hook. That was like I wanted to be the Inner Circle Trader back then. I didn't know everything I knew now, but I was on America Online, and I was teaching people before I really should have done it. And I got myself in a little bit of trouble, almost. I was doing kind of like recommendations, and everything that I was talking about was doing very well, but the CFTC tapped me on the shoulder, and I got subpoenaed and said, look, what you're doing is not lawful.
Yeah,
and
you have to be registered.
Right. So I had to go underground for a little while and just learn. I didn't put any disclaimers out. I didn't know I had to do those types of things because, who's going to listen to me? But apparently a lot of people was listening to me back then. So the Inner Circle Trader handle came from Larry Williams. He used to do workshops, and he would call them the Inner Circle Workshops. Okay. And I was like, oh, well, Trader, Inner Circle Trader, and there you go. And then it just became shortened by one of the ladies over on Baby Pips.
Okay.
She gave me the acronym.
Who wouldn't want to be part of the Inner Circle?
Yeah,
as we all feel outside most of the time. So anything you want to wrap it with, buddy? Like the most important thing you could tell people the most important lesson you've learned over your long trading career. You know, I've asked Jack Schwager this question, and he said, find a trading style that suits your personality.
Absolutely.
What would you tell the audience today?
Well, the first thing is don't believe 99% of the things that you see other people say they're doing or know, because 90% of them are doing the same things that the books are teaching, and they probably don't have a lot of discipline. So the folks that can show and teach that before the fact what's going to happen and give a great deal of detail as to why it should take place, gravitate to those types of people. And I'll give you one, and I only have one that I would recommend outside of what I teach, and it's Chris Laurie. He teaches price action based analysis, and it's not a lot of fluff. It's a lot of work to understand it, but anyone that's ever looked at his material, you can see it's nothing like everything else. It's not retail based things. It's all price action, no indicator, reliance.
Chris is excellent.
I think that if you're a new student of the markets or a new trader, the worst thing you could do is try to build a report card view of how well you're doing based on your results, because you don't know anything. And I'm going to tell you, the first 10 years of your trading, you're not going to know anything. You're going to be learning a lot about yourself, and that's the biggest thing that's going to be a barrier to you is the person staring you right back in the mirror. That person, whether you realize it or not, is going to ruin you or allow you to succeed, and you have to give the permission to do either one. And if you don't take control of it early on and recognize those repeating things that cause either ruin or success, the only way you're going to be able to do that is journal. You have to journal everything you do in the marketplace, your thoughts. When you're right, they're not important. When you're wrong, that's where your lessons are going to come from. All of your learning and your development is going to come from where the pain resides. Most people are going to quit this industry because of the pain and the uncertainty. The ones that actually do well are the ones that embrace the uncertainty and accept it. And we don't have to be perfect. I don't have to be right on every trade. I don't have to make a lot of money on every trade. And I don't have to do 90+% accuracy. I just need to be consistent. Am I doing the same thing over and over again? Does it give me what my reasonable expectations should be? And am I following the rules I've put in place for myself? If I do that, and if I can communicate that to my students, the process takes care of itself. You just can't worry about the money. And it sounds like an oxymoron because we all get into this for the money. But if you start worrying about it or not having made enough, or looking at a trade that you got out, whether it be practice or live, going back and looking at those trades and saying, I wish I would have. As soon as you do that, you're making an error. You can't do those types of things because once the trade's closed, you can't make any more money and you can't assume any more risk. So there's no point in doing that. The only thing you can do is look at what you're doing wrong, because if you're making money, no one quits this business because they made money. It never works that way. They stop because they've been taken out because of a margin call, they've blown their account, or they just can't weather the ups and downs. It's normal. That is normal. But a new trader, when we come into this, that adversity is alien to us. So wait a minute, my friend said he's always making money, or this guy on the internet, or this ICT guy, he's always showing wins. It doesn't always work like that, and especially as a new trader. So the hardest thing you're going to have to deal with is the mental aspect of it, the psychological standpoint. It's not the trading is difficult. It's the thought process behind it, because it's easy when you look at the chart, but when you put your money on the line, suddenly you start thinking, man, this thing's already went back against me 20 pips. I'm up 80, but it went back 20. Should I hold on to it? I got a goal of 110 pips, and you start wrestling, and you have to learn a lot about yourself. And those are the points at which I think traders should spend the most time delving into, not where's the next setup, what's the next pattern, who can I learn more from, because all you need is one setup. One particular pattern of setup.
Let me capsulize this. Run away from people who say they have the secret of trading, because there is no secret. The secret is hard work, perseverance, and persistence. And also journaling, because from an NLP perspective, you have to write things down for it to make an impression on you, and you learn from your mistakes.
Absolutely.
So I have your philosophy here, buddy?
Absolutely.
Well, Michael, I want to thank you again for taking time out of your day to edify face our community. And like it or not, you're now my trading warrior brother. It's been a pleasure meeting you, and
Thank you,
I
sir.
wish you continued success. And I guess we're brothers in more than one way in trading. So again, Michael, thank you very much for being with us today. Appreciate your time, and we'll have this video out in the Twitter sphere in a few hours.
Awesome, sir. Thank you very much.
Okay, that was Michael Huddleston, Twitter handle at I_am_ICT. Looks like the dollar's coming off a little bit here, guys. And we'll wrap it up with the TGIF. I want to thank all the viewers from investing.com for joining us today. Good hunting the rest of the day. If you join ForexAnalytix, you'll see the team in the private chat. And remember, most of all, don't just count your pips, count your blessings. And I'll see everyone to wrap up the week tomorrow. Thank you again, Michael Huddleston. It was a pleasure meeting you. Adios.